Welcome back. The S&P 500 in the U.S. has hit an all-time record high today. It's not far off that level now at 6,094 points. Our next guest, however, says we could see a choppier start to the trading year before long. For more on what's in store for U.S. markets, let's bring in Drew Pettit. He's U.S. equity strategist with Citi Research. He joins us now from Buffalo. Drew, thanks a lot for joining us. What do we make of these U.S. markets? They are off to a very hot start in only the first couple of weeks of 2025. The S&P 500 now up more than 3.5%. The NASDAQ Composite is and the Dow are getting close to 4% increases this month alone.
Yeah, it's funny. Well, thanks for having me, Paul, and thanks for giving me the break from shoveling here in Buffalo. But for the S&P, it's funny. We had that late 2024 volatility that spilled into the beginning part of this year. It actually took the index down almost to 5,700, which is kind of that level that resets what we think is kind of a fair risk reward. Right now, we're back at 6,100, and that's honestly our mid-year target. We still think there's a lot of policy uncertainty ahead, especially on the tariff front, and something like taxes may be targeted more as like a mid-year or kind of summer tailwind. So we do expect some chop in the first half. But ultimately, our longer run view is fundamentals are really intact. So the U.S. market is still attractive at this point.
It's hard to predict the future on this tariff front, but what is Citi's call on where this is going? It's very common to hear people call this an aggressive opening position by the U.S. president, that a period of difficult negotiations with trading partners, including Canada, will ensue, and then something much more modest than 25% tariffs will be the result. There are also forecasts out there that putting a big tariff on, for instance, Canadian oil will before too long raise gasoline prices in many parts of the United States, something that no U.S. administration wants to see.
Yeah, this is where it gets messy. Honestly, we don't really have a baseline call here because we're working on the same information you are coming out of the White House. But what we're thinking is narrow tariffs end up really not being a major negative for the U.S. market, considering we have other tailwinds from deregulation and taxes. If we get something that looks like more broader and aggressive tariffs, including those on Mexico, Canada, and China, you probably have something that actually dents S&P 500 gross margins. So basically our math, a little bit back of the envelope at this point, for every 10% increase in tariffs, you probably have a 2 to 3% hit on gross margins. Yes, margins are set to expand for the S&P, but they might not expand as much if we get aggressive tariffs, all else equal.
So with all that macro and political uncertainty, you believe the right posture for investors right now is to pair exposure to mega cap growth. So you seem to continue to like the big tech stocks and mid cap value. So you travel on the other end of the portfolio, you travel down the market cap spectrum to mid cap value. Talk to us about that positioning.
Yeah, it's funny when we're worried about tariffs and the influence on interest rates and economic growth, the safe haven actually tends to be the secular stories that have some operating leverage. And that's the Magnificent Seven. We're getting a little bit selective in mega cap growth. I would say our favorite stocks there based on our recommended list are Meta, Google, and Amazon. The NVIDIA setup's looking better. Apple, Tesla, Microsoft might need earnings revisions to really push them higher. But I would say in general, mega cap growth has really good earnings tailwinds. We're willing to pay for that right now. On the mid cap value side, this is where we see the inflections. Whether you have a big tailwind or headwind in macro growth or economic growth, these are companies that are coming off really easy compares and don't really have high valuations. So we really want to pair the stocks that have done really well, that have further earnings growth, with the stocks that have really been beaten up, but should see that inflection in earnings growth. And that helps us basically deal with all the volatility that we see in the last few days here.
So those mid-cap value stocks are much less well-known than the mega-cap tech stocks are. One you like is Flowserve, ticker symbol FLS in the U.S. It manufactures and distributes services for industrial flow management, pumps, valves, and so on.
Yeah, this is interesting because the real focus, the real end market, to simplify this, is fossil fuels, and it has a little bit of a tie to LNG. That's really important for this story, but it's a company that's come off a couple years of tough earnings, really hasn't had much earnings growth. Its end markets are finally starting to recover. The company is focused on better profitability, and its self-help initiatives are starting to show up. That plus potential tailwinds from Trump deregulation to build out energy infrastructure actually leads us to believe you can have double-digit earnings growth in 25 and 26 for Flowserve. So it's an interesting industrial mid-cap value way to play energy without having to worry about oil prices.
What do you look for in mid-cap stocks?
So it's quality improvement. You're going to hear a lot of people when they're worried about volatility, they're going to talk about high quality. To us, we don't want high quality now that can fade. We want to see stocks that can actually improve quality metrics like ROE on a forward-looking basis. So specifically, we're looking for stocks that can expand margins and increase efficiency, which shows up in total asset turnover. We don't want a whole bunch of stocks that kind of boost earnings by just buying back shares. We're looking for that fundamental improvement. You see that a lot in the fossil fuels arena like Flowserve. You see that in some of the agricultural names that are dealing with beat up commodity prices. You even see that in some of the tourism names that just have a lot more leverage than they did, pre-pandemic, because really the competitive environment has changed. So I think there's a lot of opportunity there to pair with the obvious stories we see in mega cap growth.